Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome back to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message. And I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, we are celebrating today. Now, I look at the celebrations each day. Josh and I go over them. He tells me what I'm supposed to talk about. I don't listen. And we go from there each day. But, you know, being old, I looked at this one today, and I'm trying to figure out, is this for April Fool's Day? Is this for Halloween? Or I guess, Josh, it could be because it's Throwback Thursday. Maybe that's it. National Argyle Day. Nobody wears Argyle anymore. Now, I'm not a fashion person. You know, give me a black shirt, pair of shorts, I'm happy. But even I know that I don't see anybody wearing Argyle anymore. Joy Germ Day. I don't know what Joy Germ is. It's all in one word. I don't even know what that is. So who cares? But, you know, I bring some of these things up just to talk about them. Winter Skin Relief Day. Now, I can tell you this. I think winter skin comes all winter. And probably more than it ever did in Southern California now because, well, we have a, it's not, I guess we can't call it global warming because it's been colder here. So is it global colding? I don't know. It depends on who you're talking to and what their political agenda is. But Winter Skin Relief Day, I can tell you this, in with the peptide research I do, you get a lot of information on skin and taking care of your body. So it's a lot of good stuff there. But the one that I really, we got to go with it, Josh. You are so correct. Because I have beaten anorexia, National English Toffee Day. And I don't know if you like English toffee or not, but I can tell you, they make great English toffee at See's Candy. Not that I ever go to See's Candy, unless there's one local and there's not a line. But English toffee, See's Candy. You know, I shouldn't say it, but I mean, Trader Joe's makes a good English toffee also, but half the box is dark chocolate, and I'm not a big fan of dark chocolate. So, as they say in Ron Siegel Radio,
it is what it is.
Yeah, it is what it is. So it's just like that English toffee, but it's not on my diet. And if you want to follow our journey, rsrlinks.com/shot, rsrlinks.com/shot, you can follow the journey. Looking at the markets today, the Dow Jones Industrial Average, whoa. Last time I looked, it was a mixed market. Still mixed, but I'm looking right now. The Dow Jones is up 353 points. NASDAQ's down 134. The S&P 500 is down 8. Oil is up $1.14 a barrel. Why? Well, when we look at the Dow Jones Industrial Average, two things going on there. One of the, and you remember, Dow Jones Industrial Average is 30 stocks. And when we look at the S&P 500, obviously that's 500 stocks. The Dow Jones is I think it's all New York Stock Exchange. It used to be. The NASDAQ has some of the biggest stocks out there because that's where the tech companies are. But let's look at this. When we look at the numbers, what are the headlines telling us right now? Well, the president said he wants to increase the defense spending by 50% next year. That's going to be good for Dow Jones stocks. Those are the big boys. And the president said that we're going to be doing more of the refining of oil for Venezuela. That's our oil and gas stocks. So you can see why the Dow Jones right now is up 361 points. Good indication of what's going on there. 10-year Treasury is up 1.5 basis points, 4.169. Thank goodness we're staying below that 4.2 level. So that's good news right there. And we've got the mortgage bond is down, which means mortgage rates are up. Now, why would mortgage rates be up when the president's been talking about trying to stop the institutions from buying houses? And what do you think about that? Well, I'm going to tell you my opinion because you're listening to Ron Siegel Radio. So here it is. Do you remember 4 years of the Biden administration? One of the great talking points of the administration was getting rid of student loans. Now, he didn't have the authority of doing it. It had to go through Congress and whatnot. But he tried over and over and over again, and Congress wouldn't allow it. His executive orders were all overturned by the Supreme Court. Same thing with this one with President Trump. He doesn't have the authority to tell businesses they can or cannot buy something. Needs Congress for that. So if it went to a court case, which everything does, especially if you have anything in California. But if it goes to a court case, it'll get overturned. Congress has to act. And does Congress act on anything? No. So it's just talking. It's a good subject to deal with when you're coming to the midterms, the elections, because people want more affordable housing, but they don't look at the numbers. How much of our housing market is controlled by institutions? And I keep forgetting, Josh, I got to get that Jeopardy music put on here because I keep forgetting it. So how much of our housing market is controlled by institutions? Well, investment, non-owner occupied, is about 20%. But the vast majority of that is owned by mom and dad who have an investment property or two or three. Institutions only own about 3% of the market. So President talking about this sounds good. He doesn't have the authority. And even if they got it through Congress, it's only going to affect 2 or 3% of the properties. Now, there are some areas, very few, but there are some areas of the country where they own more than that. But on a whole, throughout the country, we're talking about 2 or 3%. You go to Austin, there's a big pocket there. There's some in Florida, big pockets. But you look at the areas where the population centers are. Do you think that a large institution wants to own property in New York City? I don't think so. Do you think big institutions want to own rental property in Los Angeles?
You know better than that.
No. They don't want to be in these areas where there's price controls and the government's mandating everything. Their idea that they have is to make money. Now, what happens when you get the government controlling these things? Look at the news. You can see it. Venezuela, Cuba, right? These areas, Iran is out of water. Think about that one. So these things where they start taking about the government controlling things, not a good idea because it doesn't turn out very well. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, 4 steps to valuing an estate. We'll talk about it. Reasons to be optimistic about the 2026 housing market and the hidden cost of going uninsured. All that and more. Reach me anytime. Off-air number 800-306-1990. 800-306-1990 or RonSiegelRadio.com.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel lending team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel lending team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Mortgage Minute today being brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual lock rates with consumers across 35% of all mortgage transactions nationwide. They do not tell us points paid, points received, or the APR. They tell us the number to put in your mortgage calculator to figure out what your principal and interest payment will be. Looks like we had a pretty good day yesterday. Almost everything, all the rates look like they're down if you're watching us on ronsiegelradio.tv or any of our socials. Conventional 30-year fixed, 6.123 down. Jumbo 30-year fixed, 6.219 down. FHA 30-year fixed, 5.962 down. VA 30-year fixed, 5.733 down. USDA 30-year fixed. The only anomaly, that one was up 5.953. And yes, we still talk about the best loan on the market, the Home Select loan. GetHomeselect.com, GetHomeselect.com is our dashboard for it. A lot of great information on that. And Josh, we're going to have to probably do some rebranding on that one, but we'll see what happens there. What's driving the market? Well, before I get to that, I should tell you that each and every business day morning, as early as the data allows, and it already allowed for today, we put up our commentary about the market. Go to our community, Ron Siegel Radio community. It's free to you. rsrlinks.com/HBOD. rsrlinks.com/HBOD is the community, and you can get our thoughts right there. But what's driving this market? Because right now, I'm looking at it. The Dow Jones is up 344 points. S&P 500 is up 7.94. We've got the 10-year Treasury. That one is at 4.167. And we've got the mortgage bond down 7 basis points. Now, when I look at this mortgage bond, why do I spend so much time on the mortgage bond? Because that's what drives mortgages. No matter what anybody tells you, mortgage rates come from the mortgage bond. And if we look at that bond right now, trading at 99.77, if you add anywhere from 0.75% to 1.25%, that's generally going to give us an indication of what we're looking at. So this bond, we're looking at the 5.0 right now. Interest rates are going to range between 0.75 and 1.25 above that. And that would put us at 5.75 to 6.25. And let's take a look and see where the rates were yesterday. And if I look at Mortgage News Daily, they were at 6.19 yesterday. And Josh just showed us the chart from OBMMI. They were at 6.123, so it fits right nicely in that range. But what's driving things right now? And the headline of our report that we put out this morning was just basically that in certain areas, the market just does not care, right? And what the issue was today was no help from jobless claims or Europe. That was the headline of our report today. So what are we talking about here? Well, we look at it and we say, okay, the president said that he wants to see $1.5 trillion military budget, which would be an increase of 50%. In order to do that, where's the money come from? We don't have extra dough, so it comes from the bond market, which means U.S. would have to issue more debt. More debt means more supply. More supply means prices go down. Prices go down means interest rates go up. So that's where part of this is coming from. But again, that's 2027 is what we're talking about. They also talked about the banning the large institutional investors from buying more single-family homes. They only buy 1 to 3% as it is right now, so that won't have a big market impact. But it is a political move. We also got the information. Q3 productivity rose to 4.9%, much stronger than estimates of 3%. Comes off of the second quarter, which was revised from 3.3 to 4.1, with much more productivity, presumably due to somewhat AI. Unit labor costs are declining. Unit labor costs fell 1.9%, which was much lower than the 1% rise expected. Q2 is also revised down from 1% to negative 2.9%. Lower unit labor cost is deflationary and would have helped the bond market if not for the president's comments. Jobless claims, we got those numbers, measures individuals filing for unemployment benefits for the very first time, rose 8,000 to 208,000. While this is still very low and did not help bonds, it does not appear the market is smart enough to figure out that it encompasses the New Year holiday. Do you really think that you got a holiday shortened week, the last 2 weeks? All right, so maybe some people filed unemployment right after Christmas. You're not getting a lot of people that are getting fired unless they got the Grinch there. So you look at that and you say, okay, good reason why the numbers are lower than what they would traditionally be. Challenger reported that in December, there were only 35,553 job cuts, lowest level in 17 months. Additionally, hiring plans totaled 10,496, which is the strongest December in 3 years. But if we look down at the numbers, this is a weak labor market. There are usually less cuts around the holidays and more hiring. More importantly, 1 month doesn't make a trend, and were so many cuts in the previous 11 months. Year-to-date cuts are the highest since COVID and the 7th highest since 1989. On the hiring side, year-to-date hiring plans are the lowest in 15 years. Now, tomorrow is going to be the big news day. We get the jobs report tomorrow. So what are the expectations? Well, we look at the projections or the forecasts for non-farm payrolls. Looks like about 60,000 jobs are what are being projected to be added. The unemployment rate going from 4.6 to 4.5. But that's just for the people that don't know better, because you are listening to Ron Siegel Radio. I'm going to tell you a little bit more about what that really means. See, the unemployment rate in November was 4.56. So they round that out to 4.6. Why is that important? Because if the unemployment number goes down 0.2%, like 0.25%, then it gets rounded back down to 4.5%. Now, with the market expecting a lower number, there could be a positive surprise, because remember, if it goes up from 4.56, if it went up just 0.9, then we're going to look at 4.57. That would be bond friendly. So just an idea of what's driving this market, because you can get the numbers. Stats are easy. You can go on google.com. You can go on ChatGPT, valued at for estate settlement purposes. The answer matters more than you might think, and getting it wrong can cost your family thousands. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Most people think they know what they own. They've got a house, some retirement accounts, maybe life insurance, a car or two. But when it comes to actually valuing an estate, whether you're doing estate planning for yourself or settling an estate after someone passes, there are specific steps you need to follow. Let me walk you through the 4 critical steps to properly valuing an estate. Step 1. First, you need to select a specific date for your valuation. Values change every single day, so you need a fixed point in time. If you're doing planning for yourself, you can pick any date. But here's where it gets interesting for estate settlement. If you're settling a decedent's estate, you actually get 2 choices. You can value everything as of the date of death, or you can choose what's called an alternate valuation date, which is 6 months after death. This gives estates some flexibility if values have dropped significantly after someone passes. Now, here's the catch with the alternate valuation date. If you sell or distribute any asset during those first 6 months, you have to value that specific asset as of the date you sold or distributed it. You can't pick and choose retroactively. First, step 2, list everything. You need to determine every single asset comprising the estate, and I mean everything: the house, bank accounts, retirement accounts, cars, boats, rental property, life insurance policies, and the business interests, everything an individual owns or has ownership in. I had a client recently who was settling his father's estate. They thought they had everything listed. Then they found out dad had a small ownership stake in a rental property with his brother from 30 years ago that had to be valued and included. These surprises happen all the time. Step 3, gather financial statements. This is where you need to get really precise. Gather all financial statements as of your valuation date. Here's what most people miss. If an account is owned individually, you include the entire value. But if the account's owned jointly with a spouse who has rights of survivorship, you only include 50% of the value. You also need to remember a few critical things. Deduct any outstanding mortgage balance from the real estate values. That $600,000 house with a $350,000 mortgage, the estate value is $250,000, not $600,000. And here's one that catches people. Life insurance. You only include life insurance in the estate when the policy owner is the deceased individual or when the beneficiary is the decedent's estate. If your kids are the beneficiaries and they're the policy owners, it doesn't count in your estate for these purposes. Step 4, calculate deductions. Finally, you subtracted debts from the total value of assets. For someone who's passed away, this includes not just the mortgage and car loans, but all those regular bills that may still be due: utilities, medical expenses, credit card balances. You can also deduct charitable gifts and estate tax obligations. The strategic angle now. Why am I talking about estate valuation on a show about strategic debt management? Because understanding what you own and what you owe is fundamental to building wealth. Your estate value is really just your net worth, and that number tells you whether your current financial strategy is working. I see families all the time who are paying extra on their mortgage, thinking they're building wealth, but when actually calculate their estate value and look at their household blended interest rate, which you can get at KeySteps, rsrlinks.com/keysteps, across all their debts, we often find they could be building wealth faster by repositioning that debt strategically. Estate planning isn't just about what happens after you're gone. It's about making smart decisions while you're here about how you manage both sides of your balance sheet, what you own and what you owe. Bottom line, if you need a referral to an estate planning attorney who understands the strategic side of wealth building, give us a call. We work with professionals who can help you with family planning while we make sure your liability side is positioned for maximum wealth building. And if you're wondering whether your current debt structure is helping or hurting your estate value, visit rsrlinks.com/keysteps. rsrlinks.com/keysteps. This tool will help you get your financial house in order and see where strategic debt management could improve both your household cash flow and your net worth. The estate, rsrlinks.com/estate. rsrlinks.com/estate will get you some more information about estate planning. Remember, strategy beats rate always, and that applies to estate planning just as much as it does to mortgage strategy. This is Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. And that's the Borrow Smart segment brought to you by GetHomeSelect.com. GetHomeSelect.com. Thanks for listening. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, reasons to be optimistic about the 2026 housing market and the hidden cost of going uninsured. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio. Or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Reasons to be optimistic about the 2026 housing market. If a move is on your radar for 2026, there's a lot more working in your favor than there has been in a while. After a stretch where many people felt stuck, 2026 is shaping up to be a year with more balance, more options, and more clarity for people who want to make a move. Not because the market is suddenly easy, but because several key conditions are shifting. Here's what the experts are saying you have to look forward to. Danielle Hale, chief economist at Realtor.com, quote, after a challenging period for buyers, sellers, and renters, 2026 should offer a welcome, if modest, step toward a healthier housing market, unquote. The National Association of Realtors, NAR, quote, top economists have one word to sum up the housing market of 2026, opportunity. Lower mortgage rates and a rising supply of homes are expected to open up the housing market, something the real estate industry and potential home buyers and sellers have been waiting for following 3 years of stagnation, unquote. Mark Fleming, chief economist at First American, quote, for the first time in several years, the underlying forces are finally aligned toward gradual improvement. Mortgage rates may drift down only slowly, but income growth exceeding house price appreciation will provide a boost to house buying power. Even in a higher rate world, affordability won't snap back overnight, but like a ship finally catching a steady tailwind, it's now sailing in the right direction, unquote. Misha Fisher, chief economist at Zillow, quote, buyers are benefiting from more inventory and improved affordability, while sellers are seeing price stability and more consistent demand. Each group should have a bit more breathing room in 2026, unquote. Why local insight matters more than ever? Just remember, while the national outlook is improving, conditions still be different based on where you live. Some markets will move faster, some will see stronger price growth. Others will remain flat, as Lisa Sturdivant, chief economist at Bright MLS, explains, quote, market performance will hinge on local economic conditions, making 2026 one of the most geographically divided markets we've seen in years, unquote. Do you want the information about your market specifically, your zip code specifically? Of course, we'll give that to you for free. rsrlinks.com/market report. rsrlinks.com/market report. And you can get that information. That's why understanding what's happening in your specific area is key. The national trend sets the stage, but local dynamics determine how they play out for you and why you need an agent. Bottom line, if you want to walk through what's expected for our local market and which trends you'll want to take advantage of, let's connect. I've got the information here on the global information. I've got a report card on every real estate professional out there so we can deal with that as well. So just give us a ring and we'll not Dave. I know that's Dave's deal is give us a ring, but that's the real-time real estate segment brought to you by rsrmoney.com, rsrmoney.com. Oh, let's see. What do we have going here next? Borrow Smart segment brought to you by gethomeselect.com, gethomeselect.com. A CT scan costs anywhere from $300 to $6,750. A heart stent procedure running between $11,000 and $41,000. A knee replacement averaging $31,124. What do these numbers have in common? They're all medical procedures that can financially devastate an uninsured family overnight. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Here's something most people don't think about when they skip health insurance to save a few bucks each month. They're not just risking their health, they're risking everything they've worked to build financially. I had a conversation recently with a couple in their early 30s, both healthy, both working, both convinced they didn't need health insurance. We're saving $400 a month, they told me proudly. Then their youngest had an accident on the playground. One trip to the ER, some imaging, and a minor procedure later, they were staring at a bill for $18,000. Ow! That savings they were so proud of, gone in one afternoon. And now they had a debt that looked a lot like a car payment, except this car wasn't sitting in their driveway. Here's what the numbers actually look like. According to the Kaiser Family Foundation, the average benchmark health insurance plan costs about $477 per month in 2024. Yeah, we know the prices are going up. That's $5,724 a year, but here's what most people miss. With premium subsidies through federal and state programs, that monthly cost can drop to around $66 nationally. Think about that for a moment. We're talking about roughly $800 a year versus potentially tens of thousands of medical debt. So what does this mean for you? It means we need to look at health insurance through the same framework I use for every financial decision. Safety, liquidity, and return. Safety. An unexpected medical event can wipe out your emergency fund, force you into high-interest debt, and derail every other financial goal you have. Liquidity. Medical debt ties up your cash flow for years. That's money you can't use to build wealth, handle other emergencies, or invest in opportunities. Return. The return here is protecting everything else you're working hard toward. Your home equity, your retirement accounts, your children's education fund, all of it stays intact when you're properly insured. I see too many families making decisions based on monthly cash flow without considering the household's overall financial strategy. They'll shop around for the best mortgage rate, but skip health insurance to save $400 a month. That's strategy. That's hope disguised as planning. Remember, when we talk about strategic debt management, we're not just looking at what you owe. We're looking at what you could owe if something goes wrong. An uninsured medical event doesn't just create debt. It creates the worst kind of debt. Unexpected, unavoidable, and often negotiated under the worst possible circumstances. Bottom line, if you're currently uninsured or underinsured, I can connect you with trusted insurance professionals who can review your options and make sure you're properly protected. And if you're already dealing with medical debt that's throwing off your household budget, let's talk about repositioning that debt strategically. Visit rsrlinks.com/keysteps, rsrlinks.com/keysteps to get your financial house in order, or head to ronsiegelradio.com to learn more about protecting your family's financial structure. Because strategy beats rate always, and that includes the strategy of having insurance when you need it. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. That's the Borrow Smart segment, brought to you by GetHomeselect.com, GetHomeselect.com. Thanks for listening. Let's see. Do we have time? Do we have time to get another report in there, Josh? Okay, we'll come back and do another report when we get so we did this one, managing money as a couple. We'll talk about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Your Credit Matters segment today being brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free. Getting married or moving in together, there's one conversation most couples avoid until it's too late, and it could cost you thousands. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. You know what's interesting? Couples will spend months planning a wedding, arguing over paint colors or debating what couch to buy. When it comes to money, crickets. And I think I've got those right. I know I've got them. Yep. And that silence can get expensive. I had a couple come in last month, been together 5 years, never really talked about their finances. She thought they were saving for a house. He thought they were paying off credit cards. Turns out they were doing neither effectively because they weren't on the same page. Here's what most couples miss. It's not just about having a joint checking account or splitting the bills. That's the surface stuff. Let's start with the big picture. When you're managing money as a couple, you need to think about three things. Can you guess what they are? Jeopardy music, please. Safety, liquidity, and return. Same framework I use for every financial decision. First question, what's your emergency fund situation? Most couples I meet have either nothing saved or one person has money tucked away that the other doesn't even know about. Neither scenario works long-term. Second, and this is where it gets interesting, what's your household blended interest rate? So you might think your mortgage rate is the only thing that matters, but if one of you has a car loan at 7%, the other has credit cards at 22%, and you're both paying these separately without a strategy, that's where the money hemorrhage is. I worked with a couple recently who were each paying their own debts. Made sense to them, kept things fair. But when we looked at their household blended interest rate, they were paying over $1,800 a month just in interest across all their debts. After we repositioned their equity and created a strategic debt management plan, we got that down to $650 a month. Same debts, different strategy. Here's what nobody tells you. Keeping money completely separate works great until it doesn't. And combining everything without a plan, that's just as risky. What you need is a system, not a complicated spreadsheet that neither of you will look at, a real system. Start with a simple budget. Doesn't have to be fancy. Just track where the money's actually going for 1 month. Most couples are shocked when they see the real numbers. Then have a monthly money meeting. I know sounds about as fun as a root canal, but here's the thing. When you know where you stand financially, there are fewer arguments. The fights about money usually aren't about money. They're about surprises and mismatched expectations. And here's the part that trips people up. Maintaining some independence is actually healthy. Some couples need individual financial space. That's fine. What's not fine is financial secrecy. The couples who do this well treat their finances like a business, not romantic, I know, but effective. They have shared goals. They review statements together and they make decisions as a team. Now, if you've got a mortgage, car loans, student credit cards, and maybe some student debt between the two of you, that's where strategic debt management really matters because strategy beats rate always. The question isn't just, what do we owe? It's what's our plan to build wealth together, and that's a very different conversation. Bottom line, if you and your partner are ready to get your financial house in order, I've created a simple tool that walks you through exactly what you need to look at. Go to rsrlinks.com/keysteps, rsrlinks.com/keysteps, and you'll get immediate access. And if you've got debt scattered across multiple accounts and you want to see what a strategic repositioning could do for your household budget, if you're a homeowner, rsrlinks.com/two-step, rsrlinks.com/two-step to learn about our strategic refinance program. This is Ron Siegel. Get on the same page financially and everything else gets easier. I am your certified liability advisor, helping families build wealth through strategic debt management. That's your Credit Matters segment, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free. Thanks for listening. I think we can do, we got plenty of time. Plenty of time. Let's do real-time real estate, brought to you by rsrmoney.com, rsrmoney.com. That's it. Well, you know something? I don't think I've got that report done properly. So we're not going to do that one today. But we're still going to do a real-time real estate brought to you by rsrmoney.com, rsrmoney.com. Headlines you've worried about your headlines. Oh, easy for me to say. Is this Monday, Josh? Oh, no. It's Friday. So maybe that's where the excitement is. Let me see if I can find the report here real quick. Headlines have you worried. That's what I want to find. Where is it? Okay, got it. Josh has the graphics before I even have the headline, the story here for you. Of course, then he's the one that takes care of getting the stories ready for us. So what the heck? Headlines have you worried about home values. You got to hear this. Hearing talk about home prices falling that may leave you worried about whether your house is losing value. But here's what you need to know. While some local markets have seen small price dips this year, home prices are not falling nationally. So don't let the headlines scare you. The vast majority of the country is actually seeing prices rise. While that may feel surprising after the headlines you've seen, if you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk, AM 1490, FM 98.1 video feed, you are seeing a map below year-over-year data from the Federal Housing Finance Agency, FHFA, to make it clear. Home price growth varies by location. Let's break down what this really shows. Most states are seeing prices rise. That's the blue part of the map, not fall. Now, the gains aren't as big as they've been in recent years, but that's okay. The story is still prices are growing. And that positive maturity is exactly why data from the National Association of Realtors, NAR, shows nationally home prices are up 2.1% compared to last year. But the headlines don't draw attention to this. They feed on the negative, but even that isn't as bad as it sounds. Yes, there are some states where homes have lost value over the past 12 months. That's the orange line in the map. That's what all the chatter is drawing attention to. But here's what the data really says. The dips aren't happening everywhere. And in selective states where prices are inching down, it's slight. The range here is negative 0.1% to roughly negative 2%. And those states are the ones where prices spiked too high too fast during the pandemic housing boom. There was always going to be a come down period after that. Now we're in it. In those places, prices are leveling off, and that's a sign of normalization, not collapse. In plain terms, home prices are not crashing, and this isn't doom and gloom or the sign of broader trouble. Just to drive that point home, here's one more thing to reassure you. Even in the few places where prices dipped slightly, most homeowners are still way ahead. Additional context from Zillow helps prove that point. Only about 4% of homes are worth less than what the original owner originally paid. 96% of homes are still worth more than the homeowners paid for them. But don't just take their word for it. See for yourself. When you zoom out and look at how much home prices have grown over the last 5 years, it's not a lot easier to understand why so many homeowners are still in such a great place. Nationally, prices are up almost 49% in the last 5 years alone. And just about everywhere saw double-digit price growth in that time frame. That's why there's no orange in the map that we've got on the screen right now. The truth is, across the board, homeowners are still sitting on substantial gains. So the negative 0.1% and negative 2% decline some states saw in 2025, that's easily absorbed. Josh, I can't see it. What does it say on there for California? Don't let the headlines scare you. What's happening with home prices this year, or in 2025, varies a lot from one area to the next. But the takeaway is clear. A small dip in some areas doesn't mean your home's value is collapsing. Thank you, Josh. 35.3% over the last 5 years in California. So even if we were the worst state, like I don't have the other chart in front of me, what the numbers were for 2025. What's that say? I see it's a zero. What, negative 0.8? Is that what it says? Negative 0.8 compared to for the 1 year, up 35.3 inclusive, negative 0.6. So if you look at that, included that is the 35.3, still pretty good. I think most people would take that. And remember, just remember this part of it. If you put 20% down, you have to multiply that 35.3 times 5 to get your cash on cash. That's about 160% increase of your return on cash. Don't let those headlines scare you. What's happening with home prices this year varies a lot from one area to the next, but the takeaway is clear. A small dip in some areas doesn't mean your home's value is collapsing. It means select local markets are correcting. And most of the time, these are the ones that saw prices rise the most during the pandemic. You're probably still in great shape. Bottom line, if you're hearing talk about price drops or crashes, a closer look at the data can help put things in perspective. That's only happening in some markets. Most of the nation is still seeing prices rise. And for the vast majority of homeowners, the long-term gains far outweigh any recent softening. If you want help understanding what's happening in your local market, give me a call because we've got the report cards, rsrlinks.com/market report, rsrlinks.com/market report. And we've got the home report card that we can send you anytime you want it, just for you. We can even do that for your address. So all you got to do is ask us for it. We have all of those things for you. That's a real-time real estate segment brought to you by rsrmoney.com, rsrmoney.com. So let's give away a couple of things, Josh, because I know we've only got a minute left, but following that last report, we got to talk about our home buyers guides. That one came, we've got the new one out for the winter, our rsrlinks.com/HBG. And if you're thinking about selling, rsrlinks.com/HSG. And if you want to know about your property, and we'll send you a report every single month, rsrmoney.com, rsrmoney.com. You can get the information on your property. And as always, I ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean for engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.